Welcome to the Market Wrap, number 116. Stuart Williamson here at the helm. APW. Now, as more economic gloom is reported, we look at the fundamentals that could support the UK property market for the future. And yes, often it's in a positive format, because we believe the UK property market is an excellent vehicle to build wealth and security of the future. And that's what we've experienced with our clients, what we've done ourselves. So please do like, subscribe and share. So first up, Bank of England expected to double interest rates as inflation hits 10%. And then secondly, we're going to cover OECD predicts economic gloom in the UK, but immigration figures perhaps suggest not. They're the main talking points. So interest rates are set to double in the next 6 months, according to traders in financial markets. They are betting that the Bank of England will have to step up its efforts to stamp out inflation, as it's hit 10.1% so far this year. In reality, it's probably a lot higher than that, because the basket of goods they use has been tampered with over the years, so probably more like 14-15%. Financial markets expect the bank to now take the base rate to 3.5% or even 3.75% in early 2023. They expect 0.5% increase next month. And the quote is, "We expect swift action from the Bank of England, with the base rate potentially doubling by this time next year," said Debratim D, an economist at Deloitte. Ms. D said, "As the bank moves aggressively to crush double-digit inflation, we are forecasting a 1.6% contraction in activity between this autumn and the next. However, this is much smaller contraction than the pandemic one. But with a sharp squeeze on consumer spending power and likely rise in unemployment, we will feel it will be significantly disruptive." British two-year government bonds yields surged to the highest since November 2008. The gap between 2-year and 10-year gilt yields, something viewed as a signal of recession, was at its most inverted on record at around minus 17 basis points. In addition, economists at the Bank of America expect inflation to peak at 14% in January, in the UK that is, when the energy price cap rises once again. Mr. Grant Fitzner, chief economist at the Office of National Statistics, ONS, said July's price rises were broad-based, but energy remained a major driving force behind inflation in July, with a litre of petrol rising to £1.89 on average compared to £1.32 a year earlier. Diesel prices were also up to £1.97 from £1.35. So, pretty grim. What does that mean for the UK market? It basically means a purchaser would need a much larger deposit to keep their mortgage repayments the same, or they'd need a much greater disposable income to be able to afford the mortgage in the first place and then keep the repayments up. At this stage, that's pretty much a disaster for first-time buyers. But many cashed-up existing homeowners will not be being affected yet, as they've been insulated via COVID savings and fixed-rate mortgages. So then I thought, well, let's look at other mitigating factors which might be positive for the market, because all you hear is negativity at the moment. Okay, number one, lack of construction. In 2021, 216,000 new homes were built compared to government's target of 300,000. And this is a continuation of the 10-year trend the Office of National Statistics shows. Number two, attraction to overseas investors. The tangible nature of investing in UK buy-to-let property continues to have a great international appeal for foreign buyers. The number of homes in England and Wales owned by foreign buyers has almost tripled in 10 years. Today, close to 250,000, or 1% of residential properties, are registered to individuals living abroad. According to research by the Financial Times, 2/3 of UK property purchased by overseas buyers comes from just a dozen countries, with Hong Kong topping the list of the single largest source of buyers. Right now, 23,000 homes in England and Wales are owned by Hong Kong residents. Again, a dramatic increase over the last 10 years, where it was 2,170. Number 3, UK residential property seen as an inflation beater. Now, coinciding with the Queen's Jubilee celebrations, Savills Research released some compelling data on the long-term inflation beating potential of the residential market in the UK, and the results of this 70-year comparison are striking. In 1952, the year the Queen came to the throne, whether you're a royalist or not, it's quite a nice analogy, the average cost of UK properties stood at just under £2,000, which is equivalent to £56,000 in today's money. Over the next 70 years, house price growth has averaged 2.2% per annum above inflation every year. That's a very strong fact when thinking about why you should be buying residential property as a hedge and as a safe haven, a builder of wealth. Number 4, use of SPVs, tax efficient purchasing vehicles, are making buy-to-let more tax palatable and tax efficient for expats especially, but also 65% of all UK buyers. When it comes to landlord sentiment today, a recent study by GetGround of hundreds of UK landlords revealed that investing even partially through limited companies helps landlords to mitigate the impact of rising inflation better than if they were to invest in property in their own names. 3/4 of those surveyed, 76%, okay, not quite 3/4, said that limited companies allowed them to adjust more easily to rising inflation, while a similar proportion, 73%, revealed that limited companies investing made them feel more protected. Okay, number 5, the COVID flight to space. While still an underlying trend, with 30% of workers spending some time of their working week working from their larger homes in the country, the cost of living crisis is forcing more of the Great Resignation generation back into work, ONS figures show. Basically, it's gone up so much in price that people are having to go back to work when they gave up when they got into their 50s. Okay, number 6, post-Brexit immigration. Now, this is quite a long article, but it's well worth listening to. In the Daily Telegraph, Ambrose Evans-Pritchard has written an excellent piece on post-Brexit immigration. Try and read it if you can, in your own right, because it is very good. He says, as of next week, Britain will have the most ethnically diverse cabinet of any major country of the OECD bloc. What's less understood is that the new Prime Minister will also preside over one of the most liberal and open immigration systems among the developed economies, and considerably more open in key respects than the large EU states. Professor John Ports from the London School of Economics was quoted as saying, "I am delighted to say that I have been proved wrong. When it comes to work visas, we now have one of the most liberal immigration systems in the world." Now, Dr. Ports was a fierce critic of Brexit in the past, and he is arguably now the country's leading expert on the economic effects of immigration. The Telegraph report goes on to say, the open door policy has sweeping implications for the growth rate of GDP and for the long-term sustainability of British public finances. Now, if you remember, post-Brexit, it was the end of the world is nigh, all the Polish workers went home, it was going to cause a nightmare. Yes, they did go home because they're going to get more wages back at home anyway. But there's a whole reshuffle as to who's coming to the country now. Basically, the detailed provisions of Britain's new immigration strategy make the UK significantly more open to legal work migrants from Africa, South Asia and the Far East and the EU. I mean, it's something like 76,000, I think, non-legal people have come into the country, but that's dwarfed by the ones who are coming in properly. So far, the UK has offered a new home to 3 million exiles from Xi Jinping's Hong Kong, should they wish to come. Hence, what's important about all the Hong Kong Chinese owning property. Furthermore, a total of 6.1 million EU EEA nationals have applied for settled status, far more than the 3.5 million originally expected. The latest immigration stats for the year to June show a record 1.1 million people were issued visas to live in the UK. a 70% rise on pre-Brexit levels. Educated Indians are leading the way, and a worker visa requires a salary of at least £25,000 or at least £20,000 for those on the short list, a shortage of jobs list. Altogether, we're looking at 400,000 migrants joining the labour force each year and possibly more. This is at least 4 times the assumption in a report called the Economic Consequences of Brexit, which was published by the OECD just before the referendum. The OECD said immigration accounted for half of the UK's total economic growth from 2005 to 2015. It argued that curbs on free movement and a weaker economy would lead to a smaller pool of skills. It would reduce managerial quality and technical progress. And based on these assumptions, it predicted a Brexit loss of 5% of GDP, or even as high as 7.7% in its most pessimistic scenario. So based on this reasoning, then presumably the OECD should be revising up its forecast dramatically in the light of the actual migrant policy and incoming data. And it goes on to say its own model must surely infer blistering economic growth over the 2020s and great improvement in skills and technical progress, unless it deems Indians and Hong Kong Chinese to be less capable than Europeans. In one report, the Office of Budget Responsibility argued that a fall of 140,000 in immigration would push up the national debt by 40 percentage points of GDP in the long run. Again, following this logic, one might conclude that if the actual rate is 300,000 higher than supported, the debt ratio will come down rapidly through organic economic growth. This paints a very positive economic picture from what I can perceive, and I'm not an economist, I'm just someone who works in property. So the overall picture, next 24 months, potentially pretty grim. Longer term, very positive. Apologies if I'm too positive, but I'm a naturally positive person. Please do like, subscribe, share, and don't forget, do not miss out on our networking evening if you get the opportunity in Singapore on the 6th of September. Do get in touch if you'd like to have an invite. We have a whole room full of professionals, mortgage people, property people, single purpose vehicle people, all those sort of types available to talk about what's happening around the UK and learn a bit from them. Thank you very much. Cheerio.